Hello everyone, Monty here, market analyst at IG coming at you from Dubai. It is a Monday morning, and boy, do we have plenty to discuss with all that's been happening. Silicon Valley Bank and the fallout, policymaker response accordingly. Let's go ahead and pull up IG's trading platform, in this case, US Tech 100. In this case, it's actually got a weighting in terms of financial sector, about 5%, so relatively lower compared to, say, Dow 30 and S&P 500, where it's usually north of 10%, can reach even 15% at times. And we saw that all three were in retreat last week, especially we're looking at week on week, but it was nowhere near as bad as when it came to the small and mid-cap stocks, Russell 2000, as well as the S&P 400 mid-cap, and nowhere near as bad when it came to S&P regional banking ETF. That was down double digits, around 16%. But so far, take a look at it, you can see that it's in a bit of a futures pointing higher as of this morning, and that means that so far favorable after what we saw in terms of the response. We are going to get through that, by the way, and let's go ahead and pull up when it comes to what happened when it comes to SVP, and afterwards we're going to take a look at the CPI preview. So long story short, when it comes to Silicon Valley Bank, yeah, we had the failure when it comes to Silvergate. We did have Signature get shut down, but in this case, when it comes to Silicon Valley, a lot of these banks are holding balance sheets with large unrealized losses because they bought these assets in a low yielding environment. And let's just say that when you get a bond in a low yielding environment, well, today, if the yields and rates are higher, that means that those bonds aren't going to be worth as much. Now, of course, if they keep holding them on to maturity, there are no losses, but should they, for whatever reason, sell them, that means that they're going to go ahead and get stuck with big losses and facing a downgrade threat from Moody's. In this case, SVB did just that. They sold a chunk of about $21 billion worth of bonds, and they took on a significant loss of a couple $1 billion. They tried to raise capital to try and plug some of that. Didn't quite materialize in time. And then at the same time, you had a lot of those fund managers sensing something was wrong, telling their venture capitals, telling their startups that were doing business with SVB, telling them get out of the market, and that just led into a big run on the bank. But the worst part, of course, was that the worries start to spread to other regional banks, because if they're seen as not too big to fail, usually you look at the big four, J.P. Morgan, Wells Fargo, Citi, Bank of America, you think, okay, those are considered too big to fail. So if something bad happens, don't worry, Fed more likely to bail out the bank, and you don't have to worry about your deposits. But when it comes to a lot of these regional smaller banks, the worries start to spread a little bit. And if you're looking at it from a retail standpoint, you're going, okay, well, if I don't usually put more than $250K in a bank, or more than $250,000 per bank, because FDIC has insures deposits up to $250,000. That's not a worry for those that are retail oriented, but for those that are business oriented, it is a bit of a fear, because businesses are going, well, hold on, what if the bank goes down and my deposits are no longer, I'm only insured up to $250K? Well, that's barely going to cover breakfast without coffee. So if that's the case, let me go ahead and shift to some of these, to one, if not more, of these too big to fail banks. So the fact that they managed to come out, and the policymakers came out and said, okay, we're going to make not the shareholders, we're going to make the depositors whole again. We're going to make sure that, don't worry, your money's still there. And you also had the Fed sort of seen as let's call it a light pivot, at least when it comes to liquidity, because they started what's called this bank term funding program. And essentially, when it comes to their comments, they said, prepare to address any liquidity pressures that may arise. Well, the whole point of having central bank tightening is you're going to have less liquidity in the system, and then what do you call it, banks and firms start to feel the squeeze. So if the Fed is saying, don't worry, if it reaches a point where there's some sort of systemic risk, then that means they're prepared to go ahead and address that concern and make sure that it's not going to result in big financial catastrophe. And that means when we take a look at the Fed mandates, people are going, okay, it's maximum employment versus price stability. Last Friday, we had non-farm payrolls. Unemployment, 3.4% rose to 3.6%, still well below what some of those Fed members were talking about when it comes to 5%, or allowing themselves the unemployment rate to go up to 5%. And that meant that they were able to focus on price stability. But then a lot of people coming out going, hold on a second, what if it's between between inflation versus systemic risk? Is the Fed going to continue their fight against inflation? Maybe they'll do it when it comes to rate hikes or keeping interest rates high, but the moment something happens, they might step in and then also they'll address some of those matters when it comes to liquidity, especially if banks can now take on loans with this new BTFP program. They can then take on loans on their assets that and at par, not mark to market. So even if they got unrealized losses, they're not going to value it based on the new valuations. They're going to take it based on what they were purchased at. And when it comes to market pricing of Fed rate hikes, following all of this, by the way, they've started to pull back a bit. So the expectation was next week in the Fed meeting that we were going to see a 25 basis point rate hike that was fully priced in before. There was a small minority going for 50 basis point hikes. Now, 50 BP is pretty much out the window. Majority not fully pricing in a 25 basis point rate hike. And Goldman Sachs, by the way, saying, there isn't going to be one. They're not expecting one at all. And we're looking now at just a majority increase in May instead of what was, there was a small minority pricing in 50 BP in May. We're looking at a majority 50 BP in May and a terminal range of 5 to 5.25%. Rate cuts, by the way, they were kind of before markets were trying to price in rate cuts at the end of the year. Then they had to stop because the Fed came out with all this hawkish and the bumps on the inflationary path. And now rate cuts are back in contention, or at least a rate cut back in contention towards the end of this year. So the narrative definitely shifting when it comes to market pricing. And before we go ahead and take a look at US CPI, what I want to do is I want to go ahead and look at the week ahead. And by the way, for those of you interested, the whole details of what's been happening and what's expected, that's all in this report. I put the link in the description for this video, so you can go ahead and click on it, and it'll take you to it, and you can take a look at all the different assets, all the different products that we have on the report. But looking at the week ahead, US CPI, which I'm about to show in just a moment, that's the big one. That's tomorrow, 5:30 p.m. our time for those of you out here in Dubai. 4:30 p.m. out here in Dubai. There's daily savings. But then afterwards, you've got US producer prices. That's going to be on Wednesday. You also have some more pricing data on Thursday with trading pricing data, and then you got inflation expectations out of U of M on Friday. Outside the US, looking at it from a more global point of view, you got China's string of data that's going to be on Wednesday. You got some UK employment that's going to be tomorrow, and then afterwards on Thursday, you got the ECB, or European Central Bank's monetary policy decision, where a 50 basis point rate hike is still expected. But let's face it, there's going to be growth. The projections are going to have to be raised when it comes to growth. Inflation lowered because they were basing it on higher energy prices that let's face it, for now have averaged lower, even if we did see a spike when it comes to the Dutch TTF late last week. But generally speaking, that we're looking at some of those revisions to be lower when it comes to inflation, higher when it comes to growth, and everyone wanting to know if there are any hints when it comes to future ECB policy, so beyond the meeting this Thursday. But let's go ahead and take it back to US CPI. We want to take a look at what's been happening and what the narrative is and what the expectations are. Month on month is February expectation. Releases in March. For February, expectations are we're going to see a 0.4% increase when it comes to the headline, and the core, excluding food and energy, of a similar increase, 0.4%. But you take a look at the narrative on the year-on-year. CPI, it was 7.1% for the November, dropped to 6.5%. 6.4, and the expectation is going to drop from 6.4 to 6%. Cleveland Fed's nowcasts are a bit higher, so not as rosy at around 6.2%, but the expectation is going to drop to 6%. But look at what's happening when it comes to the core, because the focus is kind of shifting more towards the core, even when we have higher headline readings, 6% to 5.7%. 5.6%, and only down a notch to 5.5%. By the way, the forecasts are for March. I know that a lot can happen between now and then when it's released, but is that it's going to remain sticky or maybe even rise from 5.5 to 5.6%. So really the focus now is on that stickier part of pricing data. So you can expect that markets aren't just going to be looking at the headline reading, but they're also going to be looking at very, very closely at the core. And I just want to point out that getting back to the report, these are a lot of it. We have updated sentiment, retail sentiment out of IG, institutional sentiment. We had another release out of the CFTC, the latest COT report. But one thing to note is that a lot of times it's going to be about, start of the week, it's going to be about processing the fallout, what's been happening in the policymaker response. So we've already seen that when it comes to assets that are very, very sensitive to liquidity, have done very well, crypto and gold, we're seeing that already they're breaching weekly levels. So again, looking at technical levels, when something fundamental has happened, both late last week as well at the start of this week, usually not ideal. And that's especially true with tomorrow's daily market report. Those are going to be more narrow daily levels. You can expect those to get breached as well, just because we have a big fundamental release with US CPI. But that being said, a lot of traders tell me they still want to get this. They still want to note technicals, even if they may not trade it, even if it's something that they're gonna take into consideration with fundamentals. They still like to have it. So what I'm saying is that when it comes to technicals, you might want to take it with a grain of salt at the start of this week, both with what's happening today as well as what's to come tomorrow. But with that in mind, I want to thank you guys so much for joining us. Best of luck to you all this week, and happy takes.